Good morning and welcome to the CT Global Managed Portfolio Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Christine Cantrell, Head of Investment Trust. Good morning to you.
Thanks so much, and we're delighted to be here. I'm on the distribution team for Investment Trust at Columbia Threadneedle Investments, and we would love just to hear your questions and feedback. So we're going to hear a presentation from Peter Hewitt, the fund manager of this trust since its launch, and he'll be able to go through a lot of the structure of the portfolio as well as what's driving the performance. So I'm sure there's plenty to talk about and to ask him questions about at the end as well. So I will hand over now to Peter, and please feel free to start typing in the questions and I'll ask them at the end. Thanks.
Good morning, everybody. And I'm going to kick off on the Managed Portfolio Trust just by highlighting this first slide, which is one on the key attributes. And the important thing to remember about this is that it's a long-term savings vehicle for investors. So that's what we're seeking to do. We've got two portfolios, a growth one, which is focused on capital returns only, and an income portfolio, which gives you a high level of dividend income, but also some capital growth too, hopefully. And so the bottom 3 points you see there, transfer of income, conversion facility, and tight control of discounts, these are all to do with the structure of this trust. And I'm going to just spend a very few minutes on that to start with. And then I'm going on to what's in the portfolio, what I think prospects are, how's the performance been, because I think we're doing this at an interesting time, and having had, let's just say, a difficult couple of years for investment trusts. I think things have changed, and potentially quite positively for the Managed Portfolio Trust. So I think the prospects are actually quite interesting. However, let me just go on that first point there, transfer of income. This is a completely unique feature to the Managed Portfolio Trust, or for the Managed Portfolio Trust, and it benefits both the growth shares and the income shares. Now, apologies for this apparently difficult slide. It's actually not too difficult when I explain it to you. And let me just say we kick off at the beginning of a year, and the net assets of both the income shares and the growth shares are 100. And if you focus on the growth pool, we don't pay any dividends here, but it does receive a small amount of dividend income. The gross yield of the portfolio is actually about 1.2% currently. So as these dividends, say from the likes of a Scottish mortgage, which you probably are all reasonably familiar with, has got a very low dividend yield and not the reason for owning it. But when we receive a small dividend from some of these holdings, the dividends you see there, -1, over the course of a year, that's roughly what it amounts to, about 1.2% at the moment. And as they're received in by the growth shares, they kind of get put on a conveyor belt that heads across to the income shares, where you can see a +1. And at the same time, the same amount is transferred from the income shares back to the growth shares, except it's called capital. So actually it's a round trip. The income pool gets 1% more of dividend income, and the growth pool gets 1% more of capital growth. So you're starting at 100. Let's imagine there's absolutely no change to the value of any of the investments over the course of a year. you've got roughly a 4%, it's a bit higher actually at the moment, it's probably about 4.5% natural yield from the income pool and about a 1% yield from the growth pool. And so then when you work through, you'll see that a dividend paid to the income shareholders, instead of being 4 or 4.5, it's actually 5.5 or even a little bit more. But they've got a percent or so less of NAV at the end of the year. So at the start of the year, the income pool, in theory, has a net asset value of 100, a dividend yield of 4. It goes through this income transfer process and it has a dividend yield of 5, but a net asset value of 99. And the reverse is true for the growth pool, and its net asset value at the end of the year is roughly 101. Now that's what happens in theory. It also happens in practice and has been doing so for 16 years. The box on the right just pushes the two together. And the important thing for you to know is this has no adverse tax implications for any shareholders because it's within the one company. So this is a unique feature. It's relatively small, but it just biases the returns for the income pool a little bit more to income, and for the growth pool a little bit more to growth. The other thing we've got is what's called the conversion facility. This happens once a year, annually, each October, when investors can switch their holdings between growth and income or income back to growth. We've got the important thing, a minimum level of about £250,000 to make it cost effective. And we've actually been exceeding that now for a number of years. The costs are kept to a minimum for the investor. In practice, the investment trust itself picks up most of the costs. It's done at asset value, and we try and keep the shares at pretty close to asset value. It is proving increasingly popular. Certain times there's been more from growth into income, but typically it's available for both. You can go either way. And they're not treated as disposals for capital gains purposes, because again, this is within the one company, the managed portfolio trust. And I think the important thing for shareholders to realize is you can come in, for example, if you were younger, probably you're more interested in the growth portfolio, but over time, those preferences that you have may change more towards income. And this facility gives you, with pretty low costs, the ability to change from growth to income, or indeed from income to growth should you want. So that's an interesting facility of which there's very few about in the investment trust world. So income transfer, conversion facility, and then investment company discounts. And I just want to put this slide in. Some of you will be very familiar with discounts or premiums. Some of you perhaps not quite so familiar. And so my compliance department has insisted I put this in. What is an investment company discount? It's the difference expressed as a percentage between the share price and the net asset value. Net assets of 100, share price of 85, discount 15. Net assets of 100, share price 110, premium of 10. And why is that important? And it is important because a discount or premium is one, not the only one, but it is the principal method of valuing the share price of an investment company. And it provides a guide as to whether the share price is expensive or cheap, principally in relation to its own history, or actually in relation to the wider sector. And I'm going to come on and talk quite a bit about discounts, but hopefully that gives you a thumbnail sketch of what they are. So this is a picture of the income portfolio, and since launch, and we launched in April 2008, so coming up for 16 years, And you can see here that we keep the share price in a pretty close, tight band, round about, par or premium of 1 or 2, discount of 1 or 2. Currently, it's on a premium of roughly about 1.5 or 2%. I really don't want there to be a lot of volatility. Neither do I want there to be a discount on a discount. So that's why you will see both share prices kept quite close to asset value. In the case of the growth portfolio, you can see it's gone to small discounts, currently about 2 or so. And much of that reflects just the preferences of investors. And in the last year or so, it's been much more towards income than growth, which is reflected there. But we actively buy in shares at roughly a 3% discount, and we actively issue shares at roughly a 1.5 premium. So think of that as the range where this share price in relation to asset value will be. Okay, so now just a brief summary of what this particular trust is. There you see we launched, it was a rollover from some existing share plans that we had, and we had about 40 million of assets and just over 2,000 shareholders when we did this in April 2008. The assets today are currently around about 160 million and 16,000 shareholders. So you can see there are not many large shareholders. There's no private wealth, there's no multi-assets, there's no institutions, it's all individuals. And you can actually quickly divide 160 million by 16,000. So the average size of the shareholdings is about 10,000. So we really are trying to address the retail market, small shareholders who often this is their only exposure to equities. And that gives you an active share repurchase issuance program I've explained. We've issued quite a lot of shares over the years. The last 8-9 years, we've issued nearly 50 million between income and growth, roughly half and half. We also actively buy in. Yesterday, I bought in 125,000 growth shares at £2.37. But we also issue shares too, and particularly the income portfolio has been quite popular in the last year or so. And I just want to mention this. Why consider investment companies, and particularly this company? Well, we do give you an intro to the stock market. It has a level of diversification, about 35 or 40 holdings in each portfolio. And investment companies themselves, there are some influences which are very important on how they perform. Things like borrowing or gearing, as it's called in the sector, discounts, which are very important indeed, and I'm going to spend a bit of time on that. Currency can be important too, particularly if it's invested overseas. You have to know which way the pound is moving against the dollar or the euro. Fees and costs, which has also been extremely important of late. Every investment company has got an independent board who now, over the last decade or so, have become much more active in defending shareholders' interests and trying to get the best out the fund manager at the same time. And that bottom right point may not appear that important to you, but in my view, it's one of the key drivers to how investment companies perform. And it's the performance of big companies relative to medium-sized or smaller companies. And that's what's happened really over the last couple of years. You've seen the biggest companies in the FTSE 100, the biggest companies in the S&P Composite, the biggest companies in the Euro Stoxx Index perform the very best. In the case of America, the big 7 technology companies. Over here, it's been oils, some mining companies, tobaccos, believe it or not, to some extent pharmaceuticals, a small group of companies, when we've had difficult environment for stock markets generally, have held their own, whilst mid and small caps have done a lot less well. And yet, if you take the UK as an example, the mid and small cap indexes have outperformed over the long run by a long chalk. And that's really where you want to be invested for the long run. However, they've underperformed of late, and that's one of the reasons why a lot of investment companies have underperformed, because if you're an active fund manager, it's very difficult to, say, be overweight Shell, which is 8% of the FTSE 100 index, or HSBC, which is something similar. That would be a huge bet you were taking. Much better to look for long-term growth, and that tends to reside in the mid and small caps in the UK. They've underperformed until recently, and that's one of the reasons why this is an interesting time to be considering a managed portfolio trust and indeed investment companies. So let's look at investment trusts generally, and this chart I'll explain to you. Simply put, it's the investment company sector relative to the all-share index over the last decade. If the line is rising, investment companies as a sector are outperforming. And the reverse is true when the line is falling. So you can see there from 2014, actually from sort of 2010, 2011, the investment companies have steadily outperformed the all-share index. Towards the end of 2019, as we moved into COVID, actually, they outperformed very substantially and kind of went sideways in 2021. But then, when interest rates and inflation started increasing right at the end, Q4 of 2021, they began to underperform quite substantially, and you can see lost most but not all of that long-term outperformance. So that's what I was saying earlier. The FTSE 100 was doing better. What you've seen more recently in 2023, second half of the year, moving sideways, but then in November, December, and actually subsequently, you've seen investment companies beginning to perform really quite strongly. And that's what I want to focus on, because I think a lot of this is to do with things like inflation and interest rates. And in November, you had a statement from the Federal Reserve in the US, the Bank of England in the UK, which basically said interest rates are at a peak. We're not going to be raising them any further. Inflation had begun to come down, has been coming down since then. On a month by month, month to month, you can get a number that is up a little, but actually the long-term trend is pretty firmly downwards. And that's important, and markets have taken that quite positively. Investment companies have taken it very positively. So if we do get lower rates over the course of this year, and I think there is a chance of that, then that bodes well for investment companies generally. And that's why this is a very interesting time to be talking to you about the managed portfolio trust. So just looking at this more closely, this is what two charts of the average sector discount. This is of all investment trusts. It's over the last decade, the chart on the left. And I think you can probably work out what I was saying about discounts earlier, what they are. And you can see there for the first 7 or 8 years, it tended to be the average sector discount was roughly about 5. It actually was tightening in and briefly got to a very small premium in early 2021. Since then, and since the fourth quarter of 2021, you've seen quite a marked turnaround. And the average sector discount, well, you can see if you look on the chart on the right, which focuses on really just the last couple of years, 1st Jan 2022, the average sector discount was 2. By the end of October 2023, it was 19. And that's as wide as it's been this century. You see the one blip for a couple of weeks at the beginning of lockdown and COVID, but it returned very quickly to relatively tight discount. But this steady widening of discounts, which reflects the unattractiveness in some quarters, and when inflation is rising and interest rates, in order to combat inflation, have been increased. One of the side effects was on investment company discounts, and at 19, almost an all-time high. However, given what I was saying about what happened in November last year, you can see discounts did actually tighten in quite a bit to about 14 at the end of the year. They're currently 16, and I would characterize that as expectations in financial markets for interest rate cuts became too exaggerated. I think they will happen. They'll probably be a bit more moderate than perhaps some are looking for, but they will happen as inflation comes back. And I think that has been, as inflation comes down rather, and I think that is why you've seen an element of disappointment in mid-January through to mid-February. So the average sector discount is currently about 16. I don't think it's getting any wider. And if anything, I think you can see that coming in a bit as this year unfolds. So let's get on to the investment company itself. And this is a chart on particular relevance to the income portfolio and just looks at the dividends that you've received. And I did this actually on the 12th of February, but it's much the same just now. So the yield on the all-share index currently is about 3.9%. For your information, the yield on the government all stocks index for gilts bonds in the UK is about 4.4. The managed portfolio trust income portfolio has a dividend yield of 6.3. And you can see there, if you scan your eye down the dividend record over the long term, also what we've paid out in the first half of the year. And I should say our financial year end is the 31st of May. So you'll be hearing about a third quarter dividend next month. But so far in the first half of the year, we've managed to increase the dividend by nearly 8%. And we are officially an AIC Next Generation Dividend Hero, which means you've increased your dividends for 10 consecutive years. But when you've got a yield of over 6 that is growing, now ahead of inflation, I think that's quite attractive. And one of the reasons why we have been issuing shares for the income portfolio. Anyway, that highlights for you what we've been doing on dividends. Now let's look at performance, and this kind of highlights for you performance. And this is performance to the end of January of this year. And if you look at the 1 year number, you can see the all-share index, which is our benchmark, was up nearly 2% over the year. The growth portfolio just behind it, the income portfolio quite well behind it in total returns. But if you look at the 5 year numbers, they are both lagging the all-share quite considerably. The 10 year numbers look a bit better. Growth portfolio is ahead, the income portfolio is behind. And since launch, they're both slightly ahead of the all-share index. But the reason that doesn't appear all that good just now is because of what happened over those 2 years when discounts widened on average from 2% to 19%. The result was not good performance for investment companies. And I visit lots of fund managers of investment companies where I've got shareholdings in. And if you look at the 1, 3 and 5 year records, the vast majority of them are actually behind their benchmarks. And whether that's the S&P, Euro Stocks Index, Asian indexes, or the all-share index for the UK. And it's because of what I said earlier. Big companies which is very difficult for active fund managers to get overweight in, have led the market. And so if we see mid and small caps, and over 10 or 20 years, they have vastly outperformed big companies, when they start leading the market again, I think you will see a lot of fund managers reporting much better relative performance numbers. And that will be the case too with the managed portfolio trust. Now, I've got the last quarter there, 3 months, and that's quite instructive. Yes, at the beginning of November, when the central banks made their first announcement on interest rates, that they were pausing them and they were unlikely to go higher, markets took that pretty positive. The all-share index over November, December, January up 6. But look at those two performances there. The income portfolio is up 9, the growth portfolio up 12.5. And that just gives you a little flavour of hopefully the direction of travel when we reach a stage where we're closer to interest rate cuts, and actually that happens. So that's quite important to bear in mind. Now, this next page, which I have to put in again for compliance reasons, is very busy. It breaks down each single year's performance of income and growth against the all-share index. But actually, just dwell for a minute. Let's look at the growth NAV. And if you start in 2013 and look at the all-share index, and then keep running your eyes down, and for 9 consecutive years, the growth portfolio beat the all-share index. The year to May 2022, it was almost 20 points behind, and another 6 points behind in 2023. And that's where this de-rating, the widening of discounts of investment companies more widely, affected performance. And again, something similar with the income portfolio, which was quite steady over the long run. And it has had quite a difficult 2023, and actually lagging again a bit, principally because of what's been happening to the alternatives within the income portfolio, which I'll come on to. And there you see the long run performance since inception is slightly ahead of the benchmark, but hopefully showing signs of improving. Okay, so I thought I would just dwell a little on the key investment themes that I have in the portfolio, hopefully that will play out over the next year or two. And the first one, most importantly, is UK equity trusts. I am a buyer of UK equity trusts. They are unloved, they are on wide discounts. Nobody likes the UK market, but the UK market is offering fantastic value. And some of these investment trusts, particularly those with a bias to medium and small companies, I think have outstanding bargains at the moment. And I'm going to talk to a few of the ones that I've bought in a minute or two. Private equity trusts. Again, unloved trusts. They went to extremely wide discounts over the last couple of years, 40% on average. And yet, asset values have really done quite well. They've moved sideways or increased a little, despite a very adverse environment for both inflation and interest rates. And we were worried about severe recession. Doesn't seem like it's going to be a bad recession now. And I think private equity trusts, again, offer outstanding value. So I've been a buyer of them. And finally, the other key theme is trusts with secular growth characteristics. And what I'm talking about here are particularly those trusts with big exposure to technology, to some extent, healthcare, biotechnology. Again, I'm going to mention them: Polar Cap Technology, Allianz Technology, and I think, very interestingly, Scottish Mortgage. I attended an investment seminar for Scottish Mortgage in January, and it was the first time for well over 2 years that I thought the fund managers were most definitely on the front foot and their portfolio was on the front foot. It had stopped being derated, and some of the growth characteristics of the underlying holdings, and their third biggest holding was NVIDIA, the semiconductor company, was beginning to show through. And so I stuck with some of these trusts. I sold a lot of them in January 2022, but did not sell out of them. And I've been buying them back, rebuilding the positions, particularly in the growth portfolio, really since the summer of last year. And actually, I bought more Scottish Mortgage in January. So there you are. So what I thought would be of interest for you was just showing you what is the top 10 just now, and how does that reflect what I've been telling you about some of my key themes. And here you see it. You've got some private equity in terms of HG Capital. You've got some technology, Polar Cap Technology and Allianz, which have been performing extremely strongly over recent months. You see some UK funds there, Fidelity Special Values, Law Debenture, just had results this morning, great results, outperformed the index, well done. And also Aurora, which I think is a very interesting company, quite high beta, it's a very focused portfolio, but a good fund manager in Phoenix Asset Management. And Monks too, which is another one of the Baillie Gifford trusts. It's got a longer list than Scottish Mortgage. I actually like that. The stock specific risk is a bit lower. And I was in seeing the fund manager in Edinburgh last week, and I've actually added some Monks to the portfolio. So I think what is also interesting is if you look here at some of the recent purchases, you can see there I added to Allianz Technology, Polar Cap Tech, Scottish Mortgage and Monks. I've also been buying UK small cap trusts. I've added to Henderson Smallers, and the Aberforth Fund, which is which is now quite a decent sized position for me. Aberforth are a dedicated small cap manager. They adopt a value style of investment, and the rating on their portfolio is currently about 8 times earnings. And that really is very low. A PE of 8, price earnings ratio of 8, is as cheap as they've ever been. The discount on Aberforth as of this morning is 13. And so you can buy a portfolio of quite decent smaller companies on a look-through rating of less than 7 times earnings. Seems like that's interesting to me. And I think the catalyst for these trusts to start performing will be lower interest rates, which are quite important for the market as a whole, but particularly mid and small caps. You can see there also a couple of private equity trusts. Pantheon is just outside the top 10, as is another one, Oakley Capital. And I bought Pantheon International last August when they made a very positive statement, their new chairman did, about capital allocation, and the shares were on a 40% discount. The new chairman asked the fund managers what they thought of that and did they like their portfolio. The answer was that they did, and he said, well, here's a chance for us to buy that portfolio on a 40% discount. And they decided to allocate more than £200 million. The trust has a market value of about 1.6 billion as we speak. So it's a big trust, has a strong balance sheet, but they're going to allocate £200 million to share buybacks. And they did that. They had a big tender offer in October where they bought in their shares at about a 35 discount. Very positive for the net asset value, which went up over 4% the day afterwards. But importantly, they've kept on buying the shares and will keep on buying the shares until it's on a much tighter discount. And that's hugely positive for the share price. Meantime, the underlying assets of Pantheon have been performing perfectly reasonably. And so that is one of the reasons I'm really keen on private equity. And the sales in the portfolio really companies either where the fund manager has changed. I didn't like property, actually sold Urban Logistics a few months ago. And a top sliced Ruffer, which was one of the defensive holdings. Ruffer's not been performing all that well either. So let's move on to the income portfolio, and here's the top 10 for you. You can see Law Debenture, they produced their results this morning, nice dividend increase, and that's a big portion of the portfolio. I really like that trust. You can see I've got a private equity trust, which pays a dividend out of capital, super performing fund in JP Morgan Global Growth and Income, which has probably been the best performer. But also one there, Mercantile, which is the number 5 holding, which I've been adding to. And Mercantile is a big trust. It's over 2 billion in market value. And it focuses almost exclusively on mid-caps, the FT250. And so having had a very difficult last couple of years, where it's been uphill and into the wind, in November and December, the shares went up over 15% on this rally in mid and small caps. And yet the discount here hasn't tightened in at all. It's still 13%, and I think offers outstanding value. So I like Mercantile, and you can see here some of the purchases I've been doing. Mercantile, the Edinburgh Investment Trust, and also more recently I've been buying the JP Morgan UK Smaller Companies Trust, which is merging with the JP Morgan Mid Cap Trust, so it will be a larger vehicle, and it's going to pay out a dividend of about 4% per annum. Ideal for the income portfolio. And I've also been buying some biotech in International Biotechnology Trust, which also pays a dividend of about 4%. And I think is an interesting holding for an income portfolio. And on the B side, I've been selling one or two for various reasons. Civitas was acquired last year. BB Biotech was a Swiss biotech trust, which I've sold out of because it was becoming a very concentrated portfolio. So stock-specific risk there was rising, but I do like biotechs. That's why I switched the proceeds into International Biotechnology. And Downing Renewables is a small infrastructure trust whose shares have not done that well of late, so we've let them go. Right, so just coming around now to conclusion. Prospects for 2024. There's a lot in this slide. I just want to dwell on it for you for a minute or two. Corporate earnings have begun, corporate earnings estimates in America have begun to start rising, which highlights the buoyancy of the US economy, almost despite higher interest rates. However, my feeling is at the consensus estimates is looking for 11% earnings growth from the Standard & Poor's 500, which I think is a bit optimistic. So I wouldn't be surprised if that came back a little over the course of the year. In the case of Europe and the UK, estimates are much more subdued, but curiously, estimates in the UK are holding at the moment, and at 5% are actually better than I think many have expected. But the key reason, and point 2, please look at this, the price earnings ratio is one of the key yardsticks for valuing a company, valuing a market. The forward price earnings ratio means what consensus estimates from a whole variety of analysts for the next 12 months. So in the case of America, the forward PE is almost 20. The long-term average is about 16. So the US is looking expensive, courtesy of some of these technology companies in particular. Europe is about on its long-term average, but there is one major equity market globally that is way below its average, and it's that of the UK. So you see the UK, the FTSE All Shares on a PE of about 10, and the long-term average is 14. And I'm buying holdings in the likes of Fidelity Special Values, where the PE of that portfolio is about 8, or Aberforth, where it's between 7 and 8, cheaper than the average. And so that's very inexpensive, and I think is a great time to be buying. And I've said here, I think inflation has peaked, and I think interest rates will start coming down. Expectations for 6 cuts in US interest rates this year were far too exaggerated at the beginning of this year. I think there will be reductions, perhaps 2 or 3, probably in the second half in the case of the UK and Europe. But that creates a tailwind for financial markets and equities. And so my 3 themes there, I'm selectively increasing secular growth. I'm definitely increasing UK equity investment companies, particularly with a decent exposure to medium and small caps. And I'm also raising exposure to private equity too. And then just to round off finally, and I thought this would be interesting, I looked at the growth portfolio of holdings I've had over the long term. And Allianz and Polar Cap Tech I bought, you could see there, in 08 and 09. And I did start adding a bit in the second half of last year. But despite the falls in technology stocks in 2022 and the first half of 2023, they've still made respectively nearly 8 times and 6 times the money. And I think the reason for mentioning that, same with Scottish Mortgage too, if you see, is these secular growth stocks, these are the ones where you make multiple returns on your investment over time. You do have to be patient, but they're investing in the companies of tomorrow, and I want that to be a core part of the portfolio going forward. And so that's just a summary there. I'm not going to go through this very much. And just to say, income portfolio's got a 6.3 yield, and the growth portfolio you can see with its growth characteristics. So I'll hand back to Christine, and if there's any questions, do my best to answer.
Perfect. Peter, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right corner of your screen. But just while the company take a few moments to review those questions submitted today, I'd like to remind you that the recording of this presentation will be published with the Q&A accessed by your investor dashboard. As you can see, we received a number of questions throughout today's presentation. And Christine, at this point, if I could hand over to you just to chair the Q&A, that'd be great. And then I'll pick up from you at the end.
Super, thanks very much, and thanks, Peter. That was very insightful and really appreciate that. And you did cover a lot of ground, so let's see if there are just as many questions. One from Christopher, which came in early on. With the removal of dividends by certain holdings, how sustainable are future dividend payments, and what is the strategy for maintaining or growing the dividend?
Well, good question, Christopher. And the answer is we did have 2 holdings. One I've disposed of a wee while ago, which was Digital 9 Infrastructure, who had cut their dividend. And the other one that I still hold is one called Hypnosis, a very controversial trust, which hasn't performed well and is also not paying its dividend. So that's not helpful for the income portfolio. However, some of the other holdings have actually been delivering very strong dividend growth. And we've also had some special dividends as well, which has been helpful from a couple of holdings, Biopharma Credit and also Aberforth smaller companies who've had a lot of dividend income coming through from that area. So I think our actual earnings per share may well be a little lower in this financial year. However, and this is one of the benefits for investment companies, we've got quite substantial revenue reserves, equivalent to roughly 2/3 to 3/4 of a year's dividend. And so the board would not be increasing the current dividend if they were concerned about dividends not being able to be paid in the future. And also looking out into next year as best we can, the outlook for dividends, I think, is reasonably positive. Not getting carried away here, but, our biggest holding this morning, Law Debentures, just increased its dividend, I think, 4 or 5%. So that's great news for the revenue side of the income portfolio. So It's not been easy. We are increasing the dividends, and we hope to be able to increase the dividends in the future. I can't guarantee, I can't make predictions, but we have revenue reserves, and that should give you quite a level of comfort as towards future dividends.
Thanks, Peter. One from Nicholas. How are decisions made regarding sector allocation, especially in light of the challenges faced by investment companies in the alternatives subsector?
Well, yes, alternatives. We've got a few alternatives, mainly in the income portfolio, amounting to, I'm going to say 10 to 15% of the portfolio. And in my case, the reason I owned them was simply for reasons of income and yield. And I wanted to have a diversity of sources of income for the income portfolio. So not just owning UK equity income trusts, which would have a big holding in Shell and BP and Hong Kong Bank, just in case for some reason those dividends were cut or removed. So we've got global equity income, Far East income, as well as some of the alternatives. Now, the capital performance of some of these shares has been poor. And a lot of that has to do with how those assets are valued, very much to do with discount rates, which are sensitive to the rate of inflation and overall interest rates. And so when the level of assets has been, or the value of assets rather, has been reduced, that's been reflected in share prices. And it's been across the board really in renewables. I mean, I've got quite a big holding in Greencoat UK Wind, which I think is the best of the renewables companies. It's been increasing its dividend very strongly. It increases the dividend in line with RPI, which was up, I think, 13% last year. And guess what they increased the dividend by? Yeah, they managed to increase it in line with RPI. So it'll be a bit lower this year, but it's yielding 7+. So I just think, let's hold it and see this through. Mm-hmm. And I think they should be able to see it through. So in terms of the sectors, and I've tried to give a bit of an outline for you with key themes as to where I think the best prospects for returns are in UK equities, private equity, and then basically technology, healthcare, which I think over the long run will deliver some smashing returns. So that's how I've kind of reflected that in the portfolios.
So you're trying to balance the sector exposure while still getting the income, for example, in the income share class, and making sure that that's sustainable. If some sectors then have an unfavorable period. Okay, thanks. And actually keeping on the theme of subsectors, there's a good question from Bill, because he's tying in your positivity towards technology, but also towards UK. He asks, in your technology picks, why do you favour the likes of Polar and Allianz Technology rather than a more UK focused trust like Herald Investment Trust?
Well, good question. And do you know what? Herald is just outside the top 10. So okay. I like Herald a lot. But interestingly, all three of them, I looked this morning, all three of them have discounts of roughly 11, 12, 13%, which I think is just far too wide. And to be honest with you, I'm not sure why the discounts are as wide. Perhaps in the case of Herald, it's because it's got roughly half the portfolio in the UK, and it's mainly smaller technology companies it invests in. So you could view them as being a bit more risky. Maybe the liquidity is a bit less good. But Herald's had a fantastic performance long term. I've held it for donkey's years, and I definitely intend to continue holding it. But similarly, Polar Cap and Allianz, and the reason I added to them was, and I'm not an expert on this, Bill, but they are the way to play big technology companies through investment companies in the UK. So roughly half of the portfolio of both trusts are invested in these mega techs in the US, NVIDIA, Alphabet, Microsoft, Amazon, etc. and they're huge, and they've done incredible. I mean, Nvidia, unbelievable. And so for the growth portfolio, and I'm really keen that shareholders get exposed to these holdings, which have been doing really well. And one of the reasons they've been doing well is artificial intelligence, which it just offers huge growth prospects. And I've been told by Ben Rogoff, who runs Polar Cap Tech, think of artificial intelligence similar to the internet in the 1990s, when it was just coming on stream. And, look what happened over the next 20 or 30 years. Same will be the same with artificial intelligence. So how do we get exposed to that? These two trusts are the best way to do it. So hopefully that addresses your question. But I do like Herald, not selling it, definitely not.
Super, thanks. Another question from Bill, maybe the same Bill, maybe a different Bill. Why have the wealth preservation trusts such as Ruffer, RIT and CGT been in such poor performance over the last year or two?
Yep. Well, you have picked the three, and I have actually been top slicing Ruffer. I've got the other two. And by the way, the reason I had those three plus personal assets, and also one called BH Macro, which is effectively a hedge fund. And that totaled at one point a year or so ago about 15% of the growth portfolio. It was just in case we had a horrible downturn in markets, and they hopefully would give some cushioning to the portfolio. Now, in particular, capital gearing has done okay from an asset point of view, but actually the share price did less well because they were unable to buy in shares. They tried to keep shares at close to asset value, and that's because there was a mistake in there. They have to get permission from the courts to use, I think, capital reserves to buy in shares, and that's done quite frequently by many companies. And the difficulty for capital gearing is, for some reason, it's domiciled in Northern Ireland, and it took a lot longer to go through the Northern Ireland courts. Therefore, they had to stop buying in shares for about 6 months, which impacted the share price. Now, they've recently resolved that, and the discount has begun to tighten in. In the case of Ruffer, interestingly, I'm going to see the fund manager in Edinburgh next week. I've been less impressed with the Ruffer performance. I've said to you, I've top sliced some of the holding. And so let's just see what he's got to say. I think some of their illiquid strategies and holdings in index-linked gilts have not helped over the last year, 18 months. But I'm keeping an open mind on that. RIT Capital has seen the discount widen very significantly. And I think a lot of that is to do with them perceived to be having too much in private equity, which was the reason they had a really strong, I think it was 2021. But private equity was very much out of favor in 22 and for most of last year. And that reflected in RIT Capital going from trading roundabout par to trading on a discount today of 25%. And so I think it's been a lesson to them. They need to keep a much better balance in their portfolio. I think they're seeking to do that. I do think it's at the wrong price, and I'm not going to sell it at current levels, but they will have to produce better net asset performance over the next year or two. So both Ruffer and RRT are on the watch list at the moment.
Okay, great. I think there's just one last question from Nicholas. Now, you did talk about how you feel like inflation has peaked, etc., and hopefully there are some interest rates cuts on the horizon, but maybe he's asking if the opposite was true. He asks, given the adverse investment environment, what strategies are being employed to mitigate the impact of high inflation and rising interest rates on the portfolios?
Well, that's the answer is it's not easy to do that. I mean, it really isn't. If for some reason inflation took off again, and in order to try and combat that, central banks increased interest rates, there's not really many places you can hide. Cash, yes. Some of the defensive holdings I've had, the likes of personal assets, the Brevin Howard Macro Fund, which was actually the best performer in 2022, 2023. And that's a hedge fund. It invests, it takes views on interest rates, currencies, bond markets, use a whole series of complex transactions. And the idea is it will perform differently. The idea for me holding it is it will perform really differently from equity markets. And yeah, so when equities went down significantly in 2023, the best performer, which was up 20%, was BH Macro. Sadly, there is only one BH Macro. I still have a decent holding. I'm going to continue holding it. But there's not much you can do. You can become more defensive. Maybe the lesson of the last couple of years is orientated towards those few investment companies which have big holdings or big exposure to the largest companies, and they will have an element of defensiveness to them. But other than that, I'm afraid to say financial markets, bond and equities would be badly impacted should inflation significantly increase.
Thanks, Peter. And so maybe just to wrap up, do you have any closing remarks that you want to leave your investors with, or any prospective investors?
Christine, I do, because I hope I tried to convey to you those last 3 or 4 months' performance. It's a desperately short time. Of course, it could all go horribly wrong. But actually, if you just sit and think about it, we've had in investment companies a serious bear market for a couple of years. The macro is changing, and I think the prospects for investment companies on, let's say, for the rest of this year and next year are really very, very good indeed. And I think you could have some quite substantial returns as discounts maybe start moving back towards long-term averages. So if a sector average discount was 8 or 10 rather than 16, that's a real tailwind. And on top of that, if we get mid and small caps in America, in the UK and in Europe starting to perform, then you'll see some of these investment companies I own also start to perform, and you could have some really excellent results. Meantime, the income portfolio is producing the dividend income. We had a question on that, and I'm relatively confident on the outlook for dividends there. So one of the reasons I wanted to do this particular presentation now is I think we are really interestingly poised for the next 18 months.
Great. Thank you so much, Peter. And yeah, we welcome any other feedback or comments, and we can review them and answer any other questions post the meeting. Thanks, everybody.
Perfect. Peter, Christine, thank you very much for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of CT Global Managed Portfolio Trust PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.